Hey, welcome back to YT Finance, and today we are talking about the potential of a market crash and if you should pull your money out of stocks right now. Then we're going to go over 3 ways of how you can fortify your portfolio during a market crash or even in preparation for a potential market crash, which will both lower your losses or even your risk of losses while also simultaneously giving you fantastic gains over the long term. So for more videos like this one, remember to go and smash that like button right now, subscribe if you are new, comment your thoughts down below about a potential stock market crash, and without further ado, let's get right into today's stories. So the S&P 500, which is a fantastic total stock market benchmark, is down around 9% since the beginning of 2022, and many investors are worried that we are headed toward a full-on market crash. However, no one knows for certain if this will happen. This is just speculation, which is why we're going to talk about ways we can fortify our portfolio against a market crash so we don't lose any money. Now, on the flip side, there is a potential that the stock market could continue to fall only to have a fantastic rebound, which will lead to it continuously surging after that. So it may be tempting to right now pull your money out of the market due to fear, uncertainty, and doubt that is circulating due to geopolitical drama, wars, rumors of wars, and inflation going on in our current environment. But would this be a wise move to pull all of our money out of the stock market and wait for it to bottom out and then reinvest back into the market? Well, let's take a look. The first risk that we would run by taking our money out of the stock market in times of uncertainty is the impossibility to predict exactly when the bottom would be. We don't know if the stock market will bottom or if it will start to surge again. Odds are we would most likely miss the best investing opportunity for the money that we pulled out, because even experts and professionals cannot time the market, and timing the market is definitely not a good long-term strategy. Now, you may be able to time the market in certain intervals or periods, especially if you know that an approaching catalyst is coming up. However, this is not a good long-term strategy. So pulling your money out of the market may seem like a wise choice, but it is extremely risky because we never know and we cannot accurately predict every time when the stock will either bottom out or when it will start to surge again. The reason why some investors do this is because they are convinced that if they just take their money out now, they'll just reinvest as the stock market continues to crash, and then they'll reinvest back into the stock market at a lower price. So that way, when it rebounds, they will be invested at a lower price, which will give them more gains over the long term. So they're taking full advantage of the rebound. However, this is extremely difficult and not a good long-term strategy, and I personally would never do that. The stock market is unreasonable and unpredictable, and it's nearly impossible to time. Because if you ended up pulling all of your money out of the stock market and the stock market did bottom out and start to surge, you not only missed the opportunity cost of having your stocks in the stock market where it could be giving you dividends or any potential growth, you also messed up because if you decide to reinvest, you could end up paying more for the exact same companies. So that is why this is not a good strategy to follow. Now, although some traders decide to do this regularly, this is not how you build wealth over the long term. So although it may sound counterintuitive, while the stock market is crashing, do not liquidate any positions in the stock market. The best thing to do is either to reinvest back into the stock market and double down on your high conviction plays, or you do absolutely nothing. If you simply hold your investments, you don't lose any money because you're not actually selling that stock, thus locking in those losses. They're only a loss on paper. It's only a real loss when you decide to sell that stock. So if you think that the stock market eventually will rebound, you're better off leaving your money invested into the stock market over the long term and never selling your stocks. If anything, while the stock market is going down, you'd be better off by investing more into the stock market. For instance, when the stock market is good, I always try to allocate a portion of my income to the stock market, but while the stock market is going down, I actually increase that percentage because I want to expose myself even more to the falling markets because I'm getting a fantastic discount on fantastic companies. Now, this begs the question, which companies should you be investing in while the stock market is falling? How do we choose the right investments during a market crash? Well, the best stocks to invest in is literally all of them. And what I mean by that is investing into mutual funds, ETFs, or index funds are going to be your best bet in this particular scenario. For instance, some of the 3 ETFs that I love to use are VTI, VOO, and MTUM. These are fantastic investments that you can consistently invest into that I know will bounce back eventually when the stock market eventually rebounds. And this is something that I personally practice in my portfolio. This would mean that right now is the perfect opportunity to go through your portfolio, double check the stocks that you are in, making sure that they are long-term companies with solid fundamentals, healthy financials, a good balance sheet, and very strong leadership. We want to focus on blue chip stocks, not so much as speculative red chip stocks. These would be like dividend aristocrats, value stocks, and specifically ETFs such as the ones that I mentioned previously. So now that we know never to sell our stocks, even if the stock market is crashing, and the only two available options to us should be to either do nothing or to double down on our investments, how can we fortify our existing stock portfolio to at least lessen some of these stock losses in the meantime? And although these are paper losses, we do want to lower our risk in times of uncertainty. So the first way of doing this is through diversification. Now, many investors don't like diversification because they think it actually decreases their overall gains, which is not true as long as you diversify into strong companies. On average, everyone should own at least 25 stocks or more in their overall stock portfolio. That should be spread across a plethora of different markets and industries to reduce the risk of loss. Let's say one industry or sector is hit very hard, you have the other sectors to actually keep your overall finances afloat. If you own around 25 stocks, this means that you should not allocate more than 4% of your portfolio weight or allocation to any particular stock or company to be properly diversified, or at least evenly diversified across all of your investments. Now, I personally would rather have a portfolio diversification of a weight of around 5%, which is what I personally practice. No individual stock in my portfolio makes up more than 5% because I am a very risk-averse investor, which is why times like this, when the stock market is crashing, I am still way in the green right now, while other investors are freaking out and their portfolios may even be in the red. Because imagine if you invested everything and all of your money into one company, even if it's a fantastic company like Google. If anything ever happened to Google, or if there was a giant scandal, or if Google had to be shut down, or law enforcement had to get involved, and that company and stock price ended up crashing, you literally just lost everything, and I am not willing to bet everything on one particular company, which is why it's much wiser to spread your investments and your capital over a multitude of various good companies. Why would you only invest into one company when you could invest into a plethora of fantastic companies? This not only could potentially give you a similar growth rate, but it also lowers your chances of any risk, and it lowers your risk of any losses. This is why index funds and ETFs such as VOO, which track the S&P 500, which are the top 500 largest companies in the United States, are so good. These are the things that we should be investing in while the stock market is falling, because one, we know it's going to rebound eventually because historically it has. The second thing we can do to fortify our portfolios in times of uncertainty or even a market crash, or even in preparation for a market crash, is to make sure that we're using money that we don't need for the next 5 years. If you are investing right now for money that you think you will need within 5 years, you probably shouldn't be investing that money. The money that you are investing, you should not anticipate that you are going to take this money out within the next 5 years, and you definitely shouldn't need this money anytime soon. And if you do this, you're not going to be sweating in times of uncertainty or while the stock market is going down, because clearly you do not need that money right now, which allows you plenty of time for the stock market to eventually surge back up and start appreciating again. So using money that you won't need for the next 5 years not only gives you peace of mind, it lowers the risk of you making a very drastic decision that could impact your overall wealth over the long term. And we clearly do not want that. Our goal here is to build wealth over the long term by following aggressive long-term investing strategies. The third way we can bolster our portfolios against any uncertainty or even a market crash is to not only diversify within stocks, but also in other asset classes. For instance, real estate. And if you don't have enough money to go and buy physical real estate, there are other options available to you, such as REITs. There are REIT ETFs and REIT companies that pay you fantastic dividends because they actually use your money to go and buy real estate, and they give you and pay you back the money that they have obtained from renting out that piece of property. And now you own stocks and real estate to a certain degree. You can also diversify into other asset classes such as cryptocurrencies. Cryptocurrencies, as long as you are very safe, can also pay you very well because many cryptocurrency exchanges will actually pay you just to hold cryptocurrency on their platform, either by staking or they'll pay you a certain interest rate. Another thing you can do is you can have cash on hand. Everyone should have an emergency fund. And this emergency fund is going to be very important in times of uncertainty, because not only could you cash flow any unexpected expenses, but you can also use this liquidity and cash to further invest into your high conviction plays like we talked about earlier. Now, if you want to invest into something even safer than stocks during a time of uncertainty, you can always invest into bonds. Because investing into a bond, specifically a government bond, is when you lend the government money and they have an IOU and they pay you interest on the money that you lent them because they're slowly paying you back over time. Other ways you can bolster not only your portfolio but your overall wealth is make sure that your cash and liquidity is in a high yield savings account or at least a certificate of deposit so it is still gaining interest while all of your other investments are downtrending. And this is of great importance because you not only want to maintain your current amount of wealth, you also want to be very liquid right now and have cash at your disposal in case any emergencies come up. And this will prevent you from liquidating your assets such as stocks, cryptocurrencies, and even real estate. So if you are consistently investing into ETFs such as VTI, VOO, and MTUM, you are going to be fine long term, and this market pullback, correction, downtrend, or even a potential market crash is not going to phase you over the long term. And if you pair that with the 3 ways that we just went over of how to fortify your portfolio, you are going to be in a fantastic position to create long-term wealth. So for more videos like this one, remember to go and smash that like button right now, subscribe if you are new, comment your thoughts down below, and I will see you in the next YT video.